welcome to this presentation. Thank you very much for coming in. Can I just get a quick sense of who's in the room in terms of who defines themselves as an investor? Okay, who is an entrepreneur? Who's not going to put their hand up regardless? All right, very good. So what I'm going to talk about is kind of a combination of entrepreneurship and investing. So to my mind, an entrepreneur is someone that solves problems and creates value in the world. And an investor is someone that uses their capital to get returns. So an entrepreneurial investor is somebody that uses their capital to solve problems, create value in the world, and get returns. And what I wanted to demonstrate over the next half hour or so is some of the ways that this can happen. And I personally believe that we're kind of on a tipping point of a very, very big change in wealth creation. And I hope to demonstrate a few of the changes that have happened in the last kind of 50, 60 years, and why I think that we're now on the cusp of another change, and specifically how you can then profit from that. So there's an amazing stat which is talked about so often that people just kind of seem to ignore it, and it comes from the World Development Bank. It's that 50% of the world's GDP comes from small business. 50% of the world's GDP. 90% of private sector employment comes from small business. Yet, if you're a sophisticated investor, there's no tool to access that. And sophisticated capital likes to be able to get in and out of deals. The problem with investing in small business, as any angel in the room will tell you, is that they're highly illiquid. It's very, very difficult to get back out of that. They're also risky. Small businesses have a tendency to fall over. And so consequently, we've got this situation where we've got a huge amount of economy that's off limits to investors. So that, to me, is the kind of the hidden opportunity. So really, the question that I'm trying to answer today is, how can you make big profits from small business? I'm going to do a little bit of history and then move us up to the current time. And I think this is a really interesting one. In the 1960s, there was a small legal change that was made in the US that triggered the REITs market. For those of you that don't know, basically what was happening in the 50s and 60s were people were buying big commercial property developments, and it was making lots of money. But the problem was that you had to be incredibly wealthy, you had to have access to incredibly big funds in order to build or buy big commercial real estate. And so what the US government said is, we want retail investors to be able to have access to that growth. And so a law was changed which allowed REITs. And REITs are basically fractional ownership of big commercial and now residential properties, and it allows the shareholder to get the rental yield from that property. But fundamentally what it did was it created liquidity in an asset class that didn't have any liquidity up until that point. And liquidity is going to be one of the key themes that I keep coming back to today. So hold that in mind. Next one I want to talk about is 20 years later was the rise of junk bonds. Now junk bonds, some of you may know, Michael Milken was kind of the founder of junk bonds, or certainly the poster boy. Junk bonds today are now called high yield bonds. And basically it was a tool that for the first time allowed investors to inject capital into corporations. And there was a whole bunch of corporations, initially in the US but globally, that didn't have access to capital through conservative banks, that suddenly through junk bonds were able to access capital. Most of the development we've seen in the last 40 years has come as a direct result of junk bonds or high yields. The cable in the ground, the mobile phone towers, this hotel, almost definitely paid for through using these debt instruments. Fast Company, Inc. Magazine called junk bonds the most important innovation in corporate America. So it allowed capital to go into companies and allowed them to grow. Very, very fundamental. In 2000s, we had another change. We had the dot-com boom. Now, what was interesting about the dot-com boom is it really demonstrated that investors love growth. So if anyone remembers those crazy times, there was huge amounts of growth, huge amounts of money went into the dot-com bubble. And actually things have continued along that path. Investors still love growth. Now what's interesting is if you look, it tends to go, we have a focus on profits and then we lose interest in profits and growth is fine. But we love companies that are fast growth. And the speed of growth since 2000 has really started to accelerate as well. But investors like growth. And they like liquidity and they like investing capital that makes construction or big projects. And then the final trend, which is very noticeable here, and I think it's been talked about for years, but I really think in the last 12 months there's been a sea change. So ESG, impact investing, corporate social responsibility. People have been talking about this for years, but there was a few fundamental shifts last year. So one of them, BlackRock, which has $7 trillion under management, said they will only invest in ESG related projects from now on. That's a huge shift in thinking. The American Chamber of Commerce, which up until last year had specifically stated that the purpose of a corporation is to return high returns to shareholders. It was all about shareholder returns. Last year they changed that. They said actually there's a whole bunch of other stakeholders we need to take into effect. We need to look at staff, we need to look at the community, we need to look at the environment. And that was signed by the 300 biggest companies in the US. Massive, massive shift in thinking. And I think it's while there's still a long way to go, I think this is a fundamental change, and I do think we will see the next 20 years this becomes a key part of every conversation in investing. What about if you could combine all of those things? So what about if you could combine liquidity, the growth, the great returns, and the positive impact? It's like somebody should write a book about that. Alpha, impact, liquidity. So those are the three areas that I wanted to look at from an investment standpoint. But before I go into that, I need to be clear. Every race, and this is a race, will have winners and losers. And the reality is most people are going to be losers in this race. I'm guessing that most of you didn't benefit from the $2 trillion REIT explosion. I'm guessing that most of you, including myself, probably got into the dot-com bubble a little bit late and got out a little bit late. I bought most of mine in '99 and I sold most of mine in 2001 once they'd lost about 90% of their value. Bonds, how many people took advantage of that explosion in bonds? Most people didn't. And even the last 10 years, it's been the biggest bull run in history, but most people haven't managed to benefit from that. So most people will lose. And there's a reason why we as average investors lose. In fact, there's 7 reasons that keep coming up. The first one is that we don't have a good track record. If you remember in the global financial crisis, Goldman Sachs went to Warren Buffett and they offered him a deal for Warren Buffett to inject capital into their business, and it was a no-lose deal for Warren Buffett. There was only upside that he could get from that deal. I didn't get offered that deal, but I don't have track record that Warren Buffett does. So most of us are never going to get access to those deals because we don't have that track record. We also don't have the network. If you look at someone like Tim Ferriss. Tim Ferriss was one of the early investors in Uber. Not because he had a track record of successfully investing in startups. That was one of the first startups that he invested in, but because he had an amazing network. Most of us don't have an incredible network that will generate these amazing deals. We tend to work on a strategy of hope. If you wander around and you network with people here, there tends to be 2 types of investors. Many of the investors you talk to, especially early on in their career, are focused on hope. When they talk about the startups that they're looking at investing in, they all talk about the possibility of success. When you talk to seasoned investors, they talk about the probabilities of failure. They're always based on making sure they don't lose too much and the upside is all bonus. But most of us tend to go into deals focused on what the potential could be. We tend to follow the herd. It's a very natural human instinct to look at social proof. If everybody else is investing in cryptocurrency, if everybody else is investing in cannabis, they must know something that we don't. So, but by the time we get into it, the people that were there at the beginning are already getting out. They're selling their investments to us. We don't know the rules. I had a conversation yesterday with an angel investor that had been had lost out, there's a polite way of putting it, to venture capitalists on a couple of deals because they'd come in, they had made an investment in good faith, but they didn't realize the rules that they were playing by. Venture capital are playing by a very different rule, and it happens in the markets as well. You can go in and you can buy a stock on the public markets based on fundamentals, and it's a great business and it's a great industry. If the next day a massive hedge fund shorts your stock, it doesn't matter what the fundamentals are. The chances are that stock is going to go down because they're playing a different game. So you've got to know the rules of the game. Most of us lack capital. We don't have the deep pockets that will allow those great deals to come to us. They will always go to people with deeper pockets. And then the final one is timing. When we tend to get into these deals, often the smart money is already starting to get out. And the bonus round is that we just don't have the capital to learn these lessons. Most angel investors will make 1, 2, 3, possibly 4 investments before they start to lose interest in the whole deal. They don't get their returns. They've now run out of money, and so they don't get the learning. I was talking to Israel Pons about the group of angel investors that he has. They do an acquisition pretty much every month, an investment pretty much every month. And by pooling their money, they're able to do that. So they're able to get this learning cycle. Most people never get the learning cycles to be able to move up that. We just don't have the resources to do it. So kind of where this gets to, and I know this is all very depressing, it's all right, it gets better. Where this gets to is if the chances of us losing are so high, as genuine investors, we're probably better off just sticking our money into a tracker fund. Tracker funds do really well. That's why there's been an explosion in them. When people stopped trying to beat the market and realized that the market average was good, that's when this explosion went into tracker funds. But where are we creating any value in that equation? Nobody calls themselves an investor, and then you ask what your investments are and you go, I'm 100% in tracker funds. It's not what we want to do as investors. It's not very exciting. Don't beat yourself up. Investing is insanely hard. I love this slide because it just shows how this is the last 10 years. And this is different asset classes that bounce around all over the place. Your chance of guessing what asset class is going to win next year are highly, highly remote. Look at this one. In 2017, if you had all your money in cash, it would have been the worst performing asset. Following year, it would have been the best performing asset. The year after, it would have been the worst performing asset. How are we supposed to keep up with that? The average professional money manager over a 15-year period underperforms the S&P by 15%. And those are professional managers with access to all the analysts, the Bloomberg terminals, all of that information at their fingertips. They still can't match just sticking it in a tracker fund. So what chance do we have? But there is an asset class. It's not even an asset class. There is something that's so niche, but it does significantly overperform over time. So this is based on a 25-year time horizon. The S&P 500 does around 10%. Private equity after fees does around 13%, as does small cap. If you were lucky enough to buy pre-IPO, so get stock in a company the day before it listed, and then sell it on listing day, on average, you'd get a 17.5% return. If you held it for a year, you would get a 23.6% return. Now this is amazing. 50% of listings don't go up above their listing price. 50% of listings only ever go down. But the 50% that do go up create enough value that on average, if you held it for a year, you get 23.6. So 23.6 compounding basically returns your money in 3 years, 1 week. Who would be happy doubling their money every 3 years? I'll be quite happy with that. So let's play a little, the last few slides are depressing, so let's play a fun game. So let's imagine that you were able, your investor was coming to you, your private banker came to you and said, look, I can get you access to pre-IPO stock the day before they list all year long. I'll keep coming to you. That would be a pretty good result. And the thing I like about pre-IPO is that you're having a direct impact. When companies raise money pre-IPO, they're raising it to go into the business. Once you buy shares on the market, you're buying shares off other investors. So there's a secondary impact. It's great. Like if I want to impact, if I believe in electric cars and I want to buy Tesla, yes, that has a secondary impact on Tesla, but actually the primary impact is to the shareholder who's selling me their shares. So pre-IPO, the money actually goes into the businesses. It creates real jobs. Imagine if your investment vehicle that your broker was offering you had the growth of a tech company. We've all seen the way these tech companies grow. We want that growth. What about if it paid dividends? Now, the thing with tech companies is they don't pay dividends. In fact, most growth companies can't pay dividends because they invest their cash in growth. Growth is very, very expensive to maintain. And what about if you could get into and out of your positions whenever you liked? What if you had full liquidity? Now, for me as an entrepreneur that invests, I see opportunities all the time. And being locked up in an investment that I can't get out of is so painful. So the opportunity cost of being locked into a deal precludes me from many, many deals because I know that coming down the line there's going to be another deal that's more attractive. So let's just recap on those. What you're looking for is an asset that outperforms all the other assets consistently, pays you a nice cash dividend, supports small businesses, creates job in the community, no lockups, so you control the risk. You can get in and out whenever you like. Too good to be true? Well, we worked it out. There's basically 5 things you would need in order for this scenario to come true. And it's basically a move from the old world to the new world. Anyone that's heard me speak before, I'm a big believer that we're moving from an era of competition to collaboration. So the 5 keys that you need liquidity. So touched on this all the way through. You've got to be able to get in and out. And even to me, that 12-month horizon of holding a pre-IPO stock for 12 months, I'm happy with 12 months, but that's kind of my outer limit. You need to use stock rather than cash to acquire companies. The problem is if you're using cash for growth, again, you can't issue dividends. You can't use that cash. You would need an unlimited supply of good businesses. If you want to get pre-IPO stock, there has to be this unlimited supply of good businesses. And then when you own these businesses, they need to be run, bless you, they need to be run by the people that are best in control and incentivized to run them. You can't be trying to manage a disparate proportion. And more importantly, it needs pioneering investors. The small companies that join something like this are pioneers, but it needs investors that are pioneers, investors that are forward thinking. And that's critical. So let's just run through those quickly. Highly liquid. So the thing that you're always looking for with liquidity is the daily volume. How are you going to get out? So oftentimes a fund that's looking to invest in a small company will look at that and say, okay, look, if I invest $1 million, how long will it take me to get out without completely trashing the share price? One of the problems that you see in many small businesses that go liquid is nobody trades their shares. And so actually you haven't got the advantages of a PLC because if nobody's trading your shares, investors can't get out again. You need to know that there are buyers waiting for you. Use stock rather than cash to acquire companies. Now, This is, if you're not familiar with the concept of accretive acquisitions, it's basically using high-valued stock to buy low-valued stock. If you're interested in it, there's a 10-minute video that I put together on YouTube. Go and have a search for it. I haven't got time to go into it now, but it's a very, very effective tool. As companies, their value of their stock increases, it gives them a very, very valuable currency that they can use. And if they can use that currency rather than cash in order to grow, it gives them a sustainable benefit. So you need an unlimited supply of good businesses for this theory to work. Now the only way you get an unlimited supply of good businesses is to solve a very, very big problem. There are a lot of great businesses out there. We just talked about the fact that 50% of the world's economy is locked up in small businesses that are currently inaccessible. So providing a solution, the solution that we worked on is how does a small business get scale and liquid without losing control. Too many of the small businesses that we saw, the only way they could grow was to get acquired by somebody else. As soon as they got acquired by somebody else, the acquiring company tried to fix them. Bought them because they were young and entrepreneurial and exciting, and then tried to teach them how to be a corporate, and all of the talent left, all of the value was destroyed. So we wrote a book about this 3 years ago. If you want a copy, just leave your business card, I'll send you a copy. Written for small businesses about how they could do that. The business owners themselves need to be incentivized and in control. Now, I am an entrepreneur. I've been building businesses for 25 years. One of the things I've learned is that entrepreneurs, like myself, are very bad at being told what to do. We're just not very good at listening to other people. And so I don't think there's any value in trying to change a way an entrepreneur thinks. You find a lot of people that do roll-up and lists, and they'll buy 20 plumbers, and they'll say, well, look, we get these 20 plumbing companies, we put them together, it makes so much sense. But you're trying to teach 20 entrepreneurs that have run their business the same way for 10, 20 years how to do business a new way. It's just not going to happen. So we believe keeping aligned incentives and having that decentralized approach. And then finally, the pioneering investors. So pioneering investors are the ones that come in early and they get the best returns. They're the ones that are willing to take a bit of a risk, but it does come with a risk. You need to have a very strong stomach if you're going to get in early, because these models, any fast growth model that's liquid is going to be very, very volatile. That's the price you pay. I love this quote from Morgan. If you want stability, buy a bond. If you want above average returns, you need to stomach volatility. And that basically means you put your investment in and you try not to look at it, because it will go up and down very, very quickly. So the 5 keys: highly liquid, fast growth PLC, use stock rather than cash, unlimited supply of good businesses. The business owners are decentralized, they've got a shared incentive, and pioneering investors willing to back it. So this was our attempt to do this. This is a company that we put together about 18 months ago. It's a UK PLC. It's listed on the Frankfurt Stock Exchange. I want to show you a couple of sort of the key things. So this was last Friday. And this was quite lucky. This was our highest ever trading day. So I thought I'll take a screenshot. 655,000. Now for a micro cap, small cap business to be doing nearly €500,000 euros of trade on a day is pretty exceptional. But the beauty of our model is that it tracks a lot of speculators and traders into the stock because there's so much activity going on. So there's a lot of liquidity. There's also a lot of volatility. Now, again, I kind of got lucky. The last 2 weeks, the share price has gone up. And this may be a coincidence, but I'm going to claim it. My book came out here. And in the 2 weeks, the share price has gone up 45%, which means that since my book came out, we've added €1 million of market cap a day. That's a good book. I'm quite happy with that. Now, of course, if it goes down, I'm going to blame macroeconomic trends and the coronavirus and everything else, but when it's going up, it's all on the book. Just to put that in some perspective, so that's 14 million euros that it's gone up in the last 14 days. In exactly the same time frame, Tesla has gone up $30 billion. Now, I do talk about Elon Musk in the book, but I don't think I can claim credit for Tesla's growth in the last few weeks. But the liquidity is really the key piece there. This is about the speed of acquisition. So this was kind of all of us getting ready. Some of you were in the room last year. And we had done, at that point, we'd done 4 acquisitions. We've now got 11 in the company. So basically, every month or two, we bring another company into the group. All of the companies that we bring in are debt-free, they're profitable. These are boring businesses. This is like carpet cleaning companies, aircon maintenance companies. On average, they're 20 years old. They're doing $1 million, $2 million, $3 million in profit. They just spit out cash every year. They're very dull businesses. But you start adding them together, you start adding them in every single month, and you become an incredibly fast growth company. Until the numbers come out probably in the second quarter of this year, we won't know for sure, but we think we're one of the fastest growing small cap listings in Europe in the last year based on revenue and EBITDA. So our revenue went from 0 to today, on a pro forma basis, we're 110 million pounds of revenue, 10 million of EBIT, and about 5 million of net cash. So incredibly fast growth by bringing in lots of good small businesses. Couple of quotes. Very good looking fella down the bottom here. So this just, we're starting to get some traction among some people that really see the value in what we're doing. So that's always a benefit. If you want to get involved with this, we make it really, really easy. The first thing I'd say is do some due diligence. Again, if you give me your card, I'm happy to send you our website and everything. Just buy some on the market. We're on the Frankfurt stock market, put €1,000 in, put something that you're not going to worry about, and just watch what we do as we keep adding companies. If you really believe in the model, come and have a chat to me. Anything above $50,000, we can do an off-market transaction. We can sweeten it a little bit. And then we're very, very transparent. Our investors are basically our customers. And so we create a community for our investors. We run events for our investors. We do a lot of communication. We're very fast growth. We are in our first year, so at the end of April, so April 31st, we'll announce our first year numbers. I obviously can't say whether or not we'll announce a dividend, but it's always been stated that it's our intention to return capital to investors. And then once we've worked with an investor for a while, we start to give them access to exclusive deals. And that's because of the volume of acquisitions that we're doing, the speed of our growth, we're starting to get some really, really interesting deals.
Is it April 31st or March 31st?
April 31st.
Please no April 31st. April 30th.
April 30th. I'm not the CFO, I'm the CEO. Really? I've been telling everyone 31st. Good point.
I was just confused because March and April being different.
Yeah, no, you're right. Good point. April 30th, yeah, exactly. Okay, my IR people will tell me off for that. Yeah. Cool. However, so yeah, if you're interested, do get involved, come and have a chat. But I just want to go back to this key idea of entrepreneurial investing, because it's not actually about our stock, it's not about our model, it's about a mindset that combines this problem solving with using your capital in a good way. The interesting thing is, if you look at philanthropy, all of the good stuff that's happening in philanthropy right now is being driven by entrepreneurs. People like Bill Gates, Warren Buffett, even Zuckerberg, they're taking innovative entrepreneurial approaches to solving problems. And that's always been the case, from Rockefeller to Carnegie. Most of the interesting stuff that happens in philanthropy gets driven by entrepreneurs. The NGOs, the governments, the charities, well-meaning, they often don't deliver nearly as good returns as the entrepreneurs. So Basically what I would encourage you to do as an entrepreneurial investor is to demand great returns, demand liquidity so that you have options, but just ensure that all of the investments that you do are making an impact. Thank you. And happy to take any questions, and there's books down the front for those that want them. Yes?
If I may, what is what is the cost to be listed that you have had to be listed in Frankfurt or also in the other markets?
So
the startups.
Why did we list in Frankfurt?
No. How much you have paid to be listed? It's because there is an initial cost to make on the market and so on. So could be a barrier first if it's.
Yeah, absolutely. I mean, look, it does. I mean, people will tell you that you can get listed for $300,000. They're lying. It costs a lot more than that, and there's a lot of people with their hands out along the way. We probably paid about $1.5 million to get our holding company listed, and that had nothing in it. It was just a holding company, and then we started to bring the other companies in behind it. There are cheaper ways of doing it, but we wanted to you need to pick your markets. Different markets offer different benefits. So for example, we're based in Singapore, but we'd never do a listing in Singapore. There's just not enough liquidity. So Frankfurt's highly liquid. Frankfurt also allows a decentralized management system. So if you look at London, for example, one of the oldest exchanges, very traditional, you need to demonstrate centralized management. Now ours is the ultimate in decentralized management because all of these companies manage themselves. The other thing that's with this model you need to be aware of is we create a lot of new stock. So every month we create new stock to do the acquisitions. Most main markets, if you create more than 20% of your market cap in new issue stock, you need to delist and reissue a prospectus. Well, for us, we'd have to do that every couple of months. It would be a nightmare. So Frankfurt's a great market for us.
Thank you.
Okay. Any other questions? Yeah.
By issuing the new stocks, is there a risk that at the end of the day you dumping the price? Because I don't know the quantity of the stocks that you are.
Yeah, so we only ever issue stock in an accretive manner, which basically means we're acquiring earnings at a lower multiple than the multiple that we're trading at. Also, when a company comes in, the stock that we issue it is locked up for 12 months, and then they have a 3-year orderly market agreement, so they can't dump it. But equally, the companies that join us, they're not exiting. So typically when you think of acquiring a company, the founder exits. In this model, while I talk to investors about us acquiring the companies, when I'm talking to small businesses, I never talk about acquiring them. They're going public using our holding company as a platform to do it. So the companies that join us are joining us because they can grow faster as part of a PLC. And I think, I don't think I'm revealing anything non-public yet, but I think every construction company, for example, in our group, has won a bigger contract in its first year of trading as a PLC than it did as a private company. Just because procurement best practice is never to give big contracts to small businesses, but once they're in a PLC, they suddenly start winning much bigger contracts. Yeah, they're locked up, but most of the founders, they're in this for the long term. And for us, this is a buy and hold strategy. So, you know, typically if you buy a company, you normally overpay and you need that company to deliver. Because this is buy and hold, we recognize that small companies kind of have peaks and troughs and have good years and bad years, and that's fine. Like, you know, all of these companies are, like I said, on average 20 years old. We're not kind of betting on startups. These are well-established companies. Cool. Yeah.
Is tax an issue in this kind of framework?
Tax.
Yeah.
It is an issue, depending on which country you're in. And so obviously every country has different rules. We're very international, so the companies that we work with are from all over the world, and so they're potentially, so for example in the UK there's Entrepreneurs Relief. Now they don't lose that when they join us, but once they sell their shares they would lose that. So yeah, I mean each company kind of has to take its own tax advice, and each investor also has to take its own tax advice. One of the things that we do in terms of issuing dividends, if we were going to issue dividends, is offer them in either cash or stock. So if you get taxed on dividends, then most people will choose to take more stock, which actually helps us as well. So it's good. Cool.
My last question was on ECG. How do you track that? How are you tracking the jobs you're creating?
Yeah.
That impact?
So that's the, to me, the challenge with ESG is it sounds great until you start drilling down, and then you realize that people have very different ideas of morality. And you know, if a company can create 100 jobs by drilling for oil in a forest, is that good or bad? So we do it purely on job creation. What we're looking for, these companies that come in, they might be doing 10 million revenue. We're hoping they're going to grow to 20 million revenue. You can't do that without adding another 100 headcount. So yeah, we track job creation. That's the sort of the fundamental for us. But equally, we tend to attract like-minded people. So one of the suggestions that came from the companies is we want to put 1% of all of our stock in a fund to support charities and projects that we each like. So that was one of the suggestions that came from the group. It's been implemented. I think it's being added to our website this week. But there's a lot of those kind of initiatives. This is a model that does attract like-minded people. So generally, entrepreneurs in their 30s don't like this model because they're still trying to prove to the world they can do everything themselves. I was that idiot once as well. Most of the business owners that we work with, they're in their 50s or 60s. They've been through 2 or 3 recessions. If they can achieve the same result, but do it through us, they're much more keen to do that. And they tend to be, you know, they join us because they like their company, they like their culture, they don't want anyone else to tell them how to run their business. So they're just kind of our people. Yeah.
How do you find the deals actually?
Yeah, so this is kind of our secret sauce. So the average private equity firm will maybe do 1 or 2 transactions in a year. We get 1,000 applications a year. So we get 2 or 3 applications every single day from companies that want to join. So I mentioned we wrote a book on this model, Agglomerate, a few years ago. It's a big bestseller, and probably 1/3 of those deals, people have already read the book and they're already sold on it. They just want to be a part of it. Now we filter that down to kind of 15 to 20 actual deals a year that we do. But because they're already sold on the deal by the time they come to us, it's kind of like a cookie cutter approach. And also what takes a lot of time in most transactions is negotiation, because an entrepreneur always values their company more than the acquiring company. In our model, it's the same template agreement for everyone. It's a multiple of earnings and it's a perpetual earn-in. So once they're in the group, the more profit they contribute, the more shares they earn. Everyone's on the same deal, so it's full transparency in the group. Everyone knows, okay, this company's overperforming, that's why they're earning more shares this year. So it's very equitable, it's very fair. There's no kind of getting into the group and going, did that person negotiate a better deal than me? And for us, it just means we can move so much quicker because it's a take it or leave it approach. Cool. Anyone else? Yes? Now, you came in right at the Q&A section, so do you want me just to quickly recap and just go over the first 45 minutes? What? Sorry, what was your question?
So you are going to recap?
No.
Well, I'm sorry, I'm late.
No problem.
But I want to know what's the minimum balance sheet size that a company should have before requesting you for listing?
Yeah, so it's not so much about the balance sheet, it's more about the earnings, the net profit that we're looking at. So the first line of acquisitions that we call strategic acquisitions are typically doing between 1 and 10 million EBIT. So these are well-established companies. However, those companies themselves will often do acquisitions. We call those tactical acquisitions. So if I just go back, so one of the companies that we're working with here, Acacia Training, fantastic adult vocational training company in the UK, run by brilliant entrepreneur Vicky. Now what she's doing is she's acquired 4 companies underneath her. Now these are small companies, they would be too small for us to normally acquire, but they sit underneath her, so she's responsible for them, so there's no management overhead for us. We create the stock to do it, still a multiple of their earnings, so they're all profitable. But there's a couple of interesting cases in that. So one of them was a small, relatively young, fast growth company, but it was starting to stall because they didn't have the experience and the size to win the bigger contracts that they should have been winning. So they did a deal with Vicky. They said, look, we want to come in underneath you. We'll split the profits with you, but we want to be able to use your size, bit of mentoring, and your resources in order to win these bigger contracts. And so what she said to them is, come in under me, I'll incubate you. Once you reach 1 million, then you can come and sit alongside me at the grown-ups table. She had another one. It was a care home. The guy, a care home training facility, the guy was in his late 60s and he was just done. He was like, look, take my business, take it off me. I just don't want to do this anymore. And it was a perfect fit with her. She could immediately, because of the way government contracts work, as soon as she got these licenses, suddenly she got more revenue on every other contract. So really easy to do. So the companies in the group are also growing through acquisition, and they can be slightly smaller deals. Anything else? Yep, one more question.
And what's the procedure? What's the procedure of approaching or requesting for listing?
For a company?
Yes.
So yeah, very, very straightforward. Get them on a call, so connect them to myself. So if you find a good company you think is a good fit, me, you and them will jump on a 3-way call. And then we have a very smooth process that we take them through. It's not, it's not a decision they're going to rush, so we don't rush them. We just provide them lots and lots of information, send them a copy of the book, all of that sort of stuff, and then they will talk to some of the business owners in the group as part of that, and generally they sell themselves on it. Quickest deal we've done is from first phone call to announcing to the market in 10 weeks. That company had all of its due diligence ready because it had just come out of another deal that had fallen through. But most deals take sort of 3 to 6 months, is about standard. So, cool. Look, I know there's lots of other conferences and interesting talks about, so I will wrap this up. If you haven't got a book already and you'd like a book, do please come down and collect one. Give me your business card. I'll send you slides, other bits and pieces. And yeah, thank you very much. Enjoy the rest of the day. Cheers.